Okay, so if you're anything like us, you know that feeling, right? That pit in your stomach when you log into your investment account and just see red everywhere.
Oh, yeah. That immediate, almost primal urge to just hit sell, get out, save what's left.
Exactly. It feels like pure self-preservation. But we know, or we're told, that reacting emotionally like that, it can be the absolute costliest mistake you make as an investor.
It's a totally understandable anxiety, but today we're not going to listen to that gut feeling. We're actually doing a deep dive into some sources that give solid strategies for when the market gets choppy, when volatility hits.
Right. We want to move past all the daily headlines trying to scare everyone and really focus on the long-term playbook.
hmm Our mission here is to cut through all that noise. We're looking at insights from a really interesting source, excerpts from Navigating Market Volatility and Long-Term Investment Strategy.
And the goal is to pull out clear, actionable things you can actually do. Kind of a shortcut to understanding when to just sit tight, maybe when you should adjust, and also touch on some surprising, bigger forces that might be at play long-term.
Forces that suggest maybe these dips are, well, temporary in the grand scheme of things.
Okay, so let's dive right in. The first, and probably the toughest piece of advice when everything looks like it's crashing down around you.
Yeah.
Don't panic.
Ah, yes. The classic. Easier said than done, of course. But the sources we looked at, they are absolutely crystal clear on this. During a big market downturn, the single worst thing you can do financially is panic selling.
Meaning, liquidating your investments just because you're scared watching the prices fall.
Precisely. It feels like stopping the bleeding, but it's often the opposite.
Okay, but just saying don't panic isn't super helpful when your screen is flashing red, right?
Yeah.
It feels like someone telling you don't be scared during a horror movie. What tools, what reasons does the source give us to fight that urge, especially, say, with our retirement money?
That's the key distinction. The context matters hugely. This advice, the don't panic sell rule, it's absolutely vital, crucially important for long-term retirement accounts. Your 401ks, your IRAs, the money you genuinely won't touch for decades.
Okay.
And the strategy here isn't based on just like blind optimism. It's grounded in technical reality.
What technical realities are we talking about? Why is writing it out the recommended strategy for those specific retirement funds?
Well, the source points to two really critical factors that kind of take the panic element out of the equation in this specific situation. First off, diversification.
Right, meaning your money isn't all in one basket.
Exactly. These accounts are usually spread out across lots of different assets, stocks, bonds, maybe international stuff. So even if one sector takes a massive hit, it doesn't completely wipe out your whole portfolio.
Okay, that makes sense. And the second factor?
This is the big one. A long investment horizon. Time.
So if I'm, say, 30 years away from needing that retirement money, that time itself is actually my biggest advantage.
Yeah, that's it, exactly. When you've got decades stretching out in front of you, you're giving the market the runway it needs to recover. And, historically speaking, it always has recovered and usually surpasses its old highs.
So selling when it's down means you lock in those losses.
You lock in the loss, and maybe even more critically, you risk missing the recovery that will come eventually. The only guaranteed way to miss out on that rebound is to be sitting on the sidelines when it starts.
Got it. So for the money you won't need for a very long time, the message is clear. Time is your shield. Let diversification and time do their work. But what about the rest of our money? The cash you were saving for something sooner, maybe a down payment in a few years, or tuition. That money doesn't have 30 years to bounce back.
Perfect segue, because you're absolutely right. Not all money is the same, and your strategy has to change based on the timeline. The sources we looked at draw a very clear line here.
Okay, so what's the advice for money you need in the, let's say, near future?
Right. So if you've got money sitting in a regular brokerage account, not retirement, and it's specifically earmarked for something big in the short term, maybe 12 months, 24 months out,
Yeah.
the advice flips. Honestly, the source suggests that money probably shouldn't have been in super high-risk stuff to begin with if the timeline was that short. But, okay, if it's there and the market dips hard, selling is actually the recommended move to protect that specific capital.
Okay, that makes intuitive sense. You can't really afford to gamble with funds, you need next year for something specific.
Exactly. But then there's another category, right? What about money in a brokerage account? Again, non-retirement, but it's also meant for the long term. Maybe it's a college fund for a newborn, or just general wealth building outside of retirement structures.
Right. Still long term, just not locked away in a 401k.
For that kind of long-term money, the sources push a really proactive, very disciplined approach. It boils down to steady, consistent contributions, month in, month out. Doesn't matter if the news is screaming crash or shouting boom.
Okay. But isn't it psychologically really hard to keep putting money in when it feels like the market's falling off a cliff? How do you actually stick to that? Is there a name for this strategy?
There is, and it's designed specifically to overcome that emotional hurdle. It's called dollar cost averaging, or DCA.
Dollar cost averaging. Okay.
Yeah, it sounds maybe a bit technical, but it's actually incredibly simple and powerful, precisely because it takes your emotions completely out of the picture. You basically commit to investing a fixed amount of money, say $200, $500, whatever it is, every single month on a schedule, no matter what the price per share is doing.
Okay, so how does that actually work for me, the investor, mechanically, especially when the market is down?
Well, think about it. When prices fall, that fixed $500 you're investing automatically buys you more shares than it did the month before when prices were higher.
Okay. More bang for your buck when things are on sale, essentially.
Exactly. And then when prices eventually go back up and are high, that same $500 buys you fewer shares. Over the long haul, this whole process averages out your purchase price. It prevents you from making the classic mistake of throwing all your money in only when the market is at its absolute peak.
Right. And this seems like the complete opposite of what a lot of people might be tempted to do, which the source advises against,
Yeah.
right? Trying to time the market.
Oh, absolutely. Trying to time the market, jumping out right before the crash, jumping back in right at the bottom. It's like trying to catch lightning in a bottle twice.
Yeah, sounds impossible.
It basically is for almost everyone. You have to be right about when to sell, and you have to be right about when to buy back in. DCA just accepts that markets are unpredictable. It substitutes that impossible quest for perfect timing with guaranteed consistency. For long-term money, it's almost always the better path.
Okay, this is all really practical advice. Now, I want to shift to something a bit more, well, controversial that came up in the source material. It's a big idea used to underpin this whole don't panic philosophy.
Okay, I think I know where you're going.
The source makes this pretty bold claim, basically saying that the stock market is, and I'm quoting loosely here, essentially rigged to rise in the long run.
Yeah, rigged is definitely a charged word choice. It grabs your attention, doesn't it?
It does.
But it's important to understand the context. The source isn't talking about, like, some backroom corporate conspiracy. They're using rig to describe what they see as a structural, unavoidable, macroeconomic necessity. The argument is that the system itself almost requires asset prices to go up over the very long term.
Why? What's the mechanism? What forces this supposed upward bias?
According to the source material we reviewed, it all comes down to systemic debt crises, specifically massive government debt.
Okay, national debt. We hear about that all the time.
Right. Governments, not just the U.S., but globally, tend to accumulate enormous amounts of debt over time. It compounds, it grows, and eventually it can become, well, crushing, unsustainable.
So when that national debt gets too big to handle, how does a government deal with it without either defaulting, which is catastrophic, or massively hiking taxes, which is politically toxic?
The tool the source points to is inflation, deliberately engineering inflation.
How does inflation help with debt?
Well, if a government owes a huge amount of money fixed in, say, dollars, and then the central bank takes actions that cause the value of each dollar to decrease over time.
So the debt stays the same number, but the value of the currency you pay it back with is less.
Exactly. They make the old debt easier to manage by paying it back with newer, less valuable currency. It's a way to effectively reduce the real burden of the debt without explicitly defaulting, devaluing the debt away, essentially.
Okay, wait. Let me connect the dots here for you listening, because this feels like a key moment. If the plan or the necessity involves deliberately eroding the value of the currency, the dollar, the euro, whatever, to handle national debt, what does that do to the price of things measured in that currency, like stocks or real estate?
They have to go up over the long run, at least in nominal terms. If the unit you're using to measure value, the currency, is consistently losing its purchasing power, then the price of real assets measured in that shrinking currency has to increase just to keep pace, just to maintain their real value, let alone actually grow.
No. Are you saying the market isn't necessarily going up purely because companies are getting fantastically better every single year, but partly because we're measuring their value with a ruler, the dollar, that's constantly getting shorter?
That's a fantastic analogy, yes. That's the core of the source's argument about this rigging. It's not just about company performance, though that matters too, of course. It's also driven by this background pressure, this systemic need to manage debt via inflation, which inherently pushes up the nominal prices of assets over long stretches of time.
Wow. Okay, that structural rigging, as they put it, is what provides the long-term tailwind, reinforcing why these scary short-term crashes are, in the grand view, just bumps along the road.
That's the idea presented. It provides a sort of macroeconomic context. It suggests that while the crash feels terrible in the moment, the larger underlying forces pushing asset prices up over generational timelines, driven by this need to inflate away debt, haven't really gone anywhere. They're still operating.
That perspective actually brings a strange kind of clarity, doesn't it?
Yeah.
It helps you understand that the day-to-day volatility, while real and painful, might be less significant than these huge, slow-moving structural tides.
Right. And having that bigger picture, understanding the larger game potentially being played, can maybe give you, the investor, a bit more confidence to just hold steady during the noise. Ignore the short-term panic triggers.
Okay, that was a really fantastic deep dive, lots to chew on there. Let's try and quickly boil down the main takeaways our sources gave us today.
Sounds good.
Okay, first, avoid that gut reaction, that panic selling, especially with your long-term retirement money. Remember, diversification and your long-time horizon are your best friends there.
Absolutely. Second, you've really got to treat your money differently based on when you need it. Short-term money needed soon. Probably shouldn't be in high-risk assets, and if it is during a dip, maybe selling is the cautious move. Long-term money, different rules apply.
Right. And third, for all that long-term money, whether it's retirement or not, seriously consider dollar cost averaging, DCA. Just setting up those automatic, regular investments.
It's about accepting you can't predict the future and replacing that impossible task with consistency. Consistency beats trying to perfectly time the market lows almost every time.
And finally, that bigger, maybe more controversial point, understanding the macro argument that the market might have this long-term upward bias, that it's rigged to rise, so to speak.
Yeah, because of that potential cycle of systemic debt needing inflation, which in turn devalues currency and pushes nominal asset prices up over time just to maintain their real value.
It's a framework that really can help bring some clarity, maybe some calm, when the headlines are doing their absolute best to make you feel fearful and confused.
Definitely. And it leaves us with maybe one final provocative thought to ponder, building on that rigged idea.
Okay.
If the source is right, and the very value of your currency is sort of engineered to decline over time because of this systemic need to manage debt, then is investing for the long haul really a choice you make hoping for aggressive growth? Or is it actually more of a necessary defense against the slow, guaranteed erosion of your wealth if you just held cash?
Wow. So investing isn't just about getting ahead. It might be fundamentally about not falling behind.
Something to think about next time you see that wall of red on your screen.